But it's an issue of market timing. What's really interesting about it is that you can say, well, yeah, it's not a really great time to invest in real estate because interest rates are so high. No, we're buying stuff that was done 2 years ago.
Yeah.
When interest rates are cheap,
Right.
or 3 years ago, 5 years ago. And it's like, it's hard sometimes to get a real correct perspective because you look at, again, I'm going to go back to this thing where people get locked into what's going on today, relative to the economy. And they say, that's all there is. It's a bad market to be buying in real estate. Really? Well, what if you could buy an asset that was financed at 3%? And you can buy it at a 20% discount to that number and then be out of that asset in another 2 years at a substantial gain. But right now, I've talked to a number of people that said they would do deals based on interest rates being where they were 3 or 4 years ago, that 2 to 3% level, especially if you're getting institutional debt on like multifamily, some of the properties I had, that the debt itself is worth more than the real estate asset. That being the case, which is the case with that, the one property we're looking at, which is A-grade multifamily asset in a prime market with sub 3% debt on it.
It was 2 point something percent is the debt.
So, I mean, that you look at it and you say, what's the value of that debt today? Well, what's the delta between 2.5 to what's multifamily going right now? Probably 6-7%. And that has that leveraged effect.